Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, 20th of April as we record. A month on from the emergency takeover of Credit Suisse, and order has very much been restored. The VIX Fear Index fell to its lowest level for 2.5 years yesterday. We are not resting on our laurels, though. We've got a packed show again today. We're going to be talking about WH Smith's interim results in just a moment. Then we'll examine our cover story this week, which is on bargain investment trusts. And we're also going to be joined by former IC Ideas editor Algy Hall to discuss his new book, 4 Ways to Beat the Market. Aside from Algy, today on the show we have Julian Hoffman. Hi, Julian.
Good morning, Dan.
Dave Baxter. Welcome, Dave.
Hello, thanks for having me.
And Alex Newman. Hi, Alex.
Hi, Dan. How you doing?
I'm very well, thank you. We are going to start, as mentioned, with WH Smith's, the High Street veteran. Half-year figures out today, and as has been a common theme of quite a few results this season, not least in retail, these figures are fairly decent, Julian.
Yes, I covered the results this morning. They actually look really good. I mean, so lots of the trading profit in their key divisions doubled. But you could put that down to expansion in the US, particularly. They seem to be doing very well at getting into US airports. And it's really a company that's built on that entire model. So essentially, they rely on opening a shop in a building where nobody can leave and pile it full of books about the SAS. Which is probably why I have 2 copies of Bravo 20. I think. So they're still the only real option. They have this kind of monopoly business where nobody has a choice but to buy their product if they want something to read. And it's a really incongruous kind of story, really, because the high street, you imagine that the high street side of things would drag the entire company down, but they seem to have done a very good job of diversifying it away from what is a declining core business. And I mean, the core business on the high street in these results is on a kind of gentle 5% decline, slope that you can sort of predict coming through. But yeah, so they keep opening stores in key places. The way to understand WH Smith is that it's all about a capital allocation story. So they're making their money out of being quite careful about how they do their capex spending. I mean, I noticed though in these results that the capex balances the depreciation. So on the face of it, the store estate is not declining in any sense, which is it comes as a surprise if you go into your average WH Smith on the high street. But what that means is that they are investing in these key locations, and that is where the money is coming from, really. So the next time you pay, £2.40 for a bottle of water, that's going directly towards funding their dividend, which also made an appearance in these results. So yes, I mean, all around it was a very good morning, and it looked like the investors took profits on what had actually been a very good run for the shares. So yeah, you can't argue with that kind of careful husbandry, really.
As you say, the UK, the high street real estate, looks fairly tired, and that's where a lot of us encounter or are used to encountering Smiths. But it is the travel side, which is 70% of group revenue already, I think, and even more of profit, as I said today. The travel side, that captive audience that really boosts figures on a regular basis nowadays, as well as the international expansion. They have North America as a place where they're opening a lot of stores, the US and Canada. Obviously in the UK they are fairly well covered, but this is, really just dipping their toe in, just starting to expand over there, and that seems to be going quite well.
Another retailer going into the US and achieving that level of market share in a comparatively small amount of time. Usually the US is a notoriously a difficult place to crack for UK retailers. So it's a commendable performance from Smiths that they got this far. But again, it's all based on the fact that in an airport terminal, nobody has any other choice but to buy their product.
Well, what about the valuation? You mentioned the good run up the shares have had. Forward PE, I was having a look earlier, is about 19. The PEG ratio is 0.9, which suggests some value there. That is the PE ratio relative to the prospect of growth in earnings. How do you see the balance for Smiths at the moment?
It sounds about right. It certainly puts the top end for retail, isn't it, in this country? Alongside the likes of Next and and in that area. So comparatively, you might be able to buy cheaper, but in terms of the quality of the earnings growth, it seems that PEG ratio is a better guide to the value prospects for it.
Yeah.
The problem I think they might find is whether there is another change in shopping habits or taste that might ultimately end the reliance we have on that sort of reading in or that sort of product in an airport. But that hasn't shown any signs so far that even with the kind of people's e-readers or things like that, that's going to change very quickly.
I mean, as the PEG ratio would suggest, there is still some pretty good earnings growth factored in by analysts for the years ahead. So there are some high expectations out there based on this international expansion, based on some of the new initiative, perhaps even in the UK. I think they've taken advantage of the likes of Paperchase collapsing. I think they've said to do more in terms of.
Oh, there's a definite last man standing syndrome coming in. I mean, what's the other one that went partially bankrupt? It was McColl's, wasn't it? I think that was the other news agency that you could sort of find in small towns, and the only one I can find around here is in Sidmouth. It has that defensiveness that comes from being able to outlast almost everyone else in the same space. So that adds an attraction to those earning forecasts, which there's every possibility they could fulfill them. It's a catch-22 from an investor's point of view. I mean, do you want to get involved in a business that has a difficult core legacy sort of offering? I don't know.
Well, as long as they continue to sell the IC in their high street shops, they should be their future should be assured, I think.
Well, we should also say it's also available in other reputable distributors.
Of course. Yeah, I mean that last man standing thing reminds me a little of the thing we had in another piece this week written by Gemma Slingo, looking at the likes of Next and M&S and how they've started to buy up some of these companies too. So there is a competition benefit perhaps there. Alex, I don't know if you had some thoughts on WH Smith, which has maybe won you over a bit in recent years.
Yeah, I mean the story is similar to when I last covered them in 2021. Or one of, obviously we've touched on it, on managed decline in the legacy business. I think at that point the strength of the travel recovery story was not yet clear, and particularly in North America, where the results they beat expectations today on that front has been really, really strong. And I suppose if you're looking over the last 5 years at this, it was a delayed turnaround story in a way, or delayed pivot, because they we had the pandemic and that shuttered their operations both on the high street and in travel. We've got to give WH Smith some credit here, because retail is not an easy business to do, and they obviously have a formula that perhaps they've learned from the high street experience on how to cram as much into a smaller space as possible. They understand the customer base very well, and how you stack up certain products next to one another to encourage impulse buying, or a different kind of basket shop. And they've applied that to travel, which is a growth market. I mean, the forecasts for over the next couple of decades for air travel particularly are that it's going to expand. So footfall there is much more of a guaranteed driver of earnings than their legacy business. I suppose when it comes down to the valuation, it's all about if they can beat estimates. And at the moment, you've got earnings forecast for this year about 79p a share. That's flatlined pretty much since the end of 2021. It's a similar picture for next year's forecasts, and then investors or analysts have been sort of revising their growth forecasts upwards for 2025. So there's a bit of can kicking that's gone on here. But if by the end of this year, as management's saying that 85% of profits are going to be coming from travel, that is a growth industry. You can start to leave behind the legacy business in your factoring in the sum of the parts valuation for the business, and start to focus on what is a growth story. So it's definitely improved, I think, as a investment case in the last couple of years. Yeah, I mean, maybe the shares are looking fairly valued at the moment, but over the next couple of years they have an opportunity to beat expectations and perhaps re-rate from here.
Yeah, certainly. I mean, this is another recurring theme we've seen in the short term, that travel boom. We've EasyJet this week as well, and EasyJet its share price performance over the last few months tells you all you need to know about that story. Really, the demand not just in the US but in Europe as well for holidays, short haul breaks is not going away. Whatever the pressures on the consumer in general. Let's turn to our cover story now, though. Dave Baxter, our funds editor, has written a piece on bargain investment trusts because while as I said at the top of the show, markets are a little bit more serene at the moment. Some of the discounts on trusts that are still available, frankly, following on from the banking mini crisis, following on from the tougher times, the higher interest rates of the past 18 months. Essentially, these discounts have not closed up in the way that some people may have expected. What kind of opportunities are out there at the moment, Dave, and what's the kind of extent of that discount widening that we've seen in recent months?
Yeah, so as you said, we've kind of maybe had a bit of a setback for markets with the events of March, and things have sort of come back. And to kind of quantify it, if you looked at the average investment trust at the turn of the year, the discount would be on 13%. And over the first quarter, that widened out to 16%. So we're again at some kind of really interesting levels. And even though discounts have been quite common over the last year, they are, extremely wide in many cases across many sectors. And you're getting this interesting sort of both gloomy and cheerful comparison with the financial crash. Times are very disconcerting, things look very uncertain, but perhaps this is a window of opportunity that might close soon. So if you have the stomach, you have the time, there are various areas you could get into. And there are so many cases, but just to give a couple of broad themes, I suppose, there are some of the kind of classic kind of growth investments that we've seen taking a hammering, whether that's kind of tech stocks or other kinds of areas. But also, and I guess we'll get into this, there are some things like, kind of inflation plays and some areas that have been really popular in recent years have also kind of looked cheaper than they were before.
You're right, we will come to those inflation plays shortly. In some cases, though, it's fair to say perhaps the discounts, or in your view, look a bit more warranted. Maybe some areas such as private equity and similar growth capital, as the sector is known.
Yeah, so growth capital, I guess, people might interpret it differently, but that tends to apply to the kind of trusts that hold mature, unlisted companies that in some cases you might expect to be sort of on the cusp of an IPO, at least when markets recover again. So one example is the kind of slightly ill-fated Chrysalis Trust, but you have all sorts of other examples like Seraphim Space, which launched a year or two ago. It's a great fanfare, went to a big premium that I think today was on something like a 65% discount. But to sort of talk about doubts, one big doubt here is what is actually priced in and how realistic is that? Because you've got these kind of unlisted companies. People could argue, particularly things like Chrysalis, that perhaps they were very generously valued at one point, and people worry in some cases, have they been kind of valued down enough? And you have had write-downs with things like Chrysalis, with some kind of Scottish mortgages unlisted, but people might still think that there's further to go. And it's also worth noting that on the kind of dedicated private equity trusts, which are also on enormous discounts, which look very interesting, there's a kind of a delay on when you get kind of valuation updates. So people feel like, perhaps there's another shoe to drop.
Yeah, it's this, as you say, this lag between the share price and the NAV. The reason in some cases that share prices are on such a discount is because they expect the NAV to fall closer to the share price. In short, But I should say, maybe we're skeptical of private equity. Some people have been talking about that as an area of interest too in itself, just because they've all traded on discounts for a long time, but those discounts have got even bigger now. So there's still some margin for error there. Other areas, you touched on them, inflation-linked plays, where again this is a different scenario to private equity, completely different in that they for many years have been on premiums, but have been in recent weeks, months, for the first time in a long time, trading on some small discounts. The likes of infrastructure trusts here perhaps look quite interesting.
Yeah, this is really interesting because I feel like whenever we've kind of written about this sector, it's been very popular because of the resilient income and because it's seemingly not really too linked to what goes on in the economy. They have lots of kind of long dated contracts and that kind of thing. But if we'd written about this any time in the past few years, we'd be talking about kind of quite chunky premiums, some kind of double digit premiums, and you really are kind of putting your faith in these trusts, names like Hickel, and kind of accepting the fact that you have to pay over the odds. What's interesting though is those trusts, they sold off pretty heavily at the time of the mini budget, kind of affected by what was going on with bond yields, and they did recover to an extent, but we haven't really seen a return to those kind of big premiums, and we actually have some discounts on names like Hickel, on names like International Public Partnerships, which are the sort of big stalwarts of the sector that people see as very reliable names, and that's quite interesting. And I suppose to turn to some subsectors, you also have the kind of digital infrastructure funds are still on some pretty big discounts, and some of the kind of energy efficiency trusts, if you want to go for that kind of more granular, maybe a bit more risky, but kind of more interesting exposure.
Yeah. I mean, as you allude to, we are in an environment of higher rates, higher bond yields, but that doesn't necessarily mean that these trusts automatically are going to be on these discounts forever. We will conclude by talking about, the most popular trust, or certainly the erstwhile most popular trust in the UK, Scottish Mortgage, which is always, hotly debated. Obviously, it's not had a good run in the short term. Over the long term, everyone knows its performance speaks for itself. On a discount of about 15 to 20% in recent weeks. Again, this is one that could go either way, perhaps, or it is for me. It's a hard one to call, but in the piece as well, we do discuss some of the pros and cons there, and some of the interesting, perhaps, analyst opinion about Scottish Mortgage at the moment. This is all aside from the very public boardroom spat that they had recently.
Just ignoring that.
Purely about the valuation in this instance.
Yeah, so analysts at Peel Hunt, I suppose, tried to sort of square the circle and work out what's going on with the with sentiment and with the kind of valuations. And they made the point that there is such a cloud hanging over Scottish Mortgage at the minute. And I guess to illustrate that, if you think in recent months you've had a big bounce back for lots of kind of growthy trusts, names like the technology trusts, and Scottish Mortgage hasn't really taken part in that. And that might be because of things like the boardroom spat and that kind of thing. But in terms of valuation, they tried to work it out by basically they applied the kind of average private equity trust discounts of around 40% to the unlisted portfolio. That's something like 30% of Scottish Mortgage. And then they applied a 15% discount to the listed assets. And that was based on the average discounts on offer in the technology sector. And sort of working from that, they believe that a blended discount of around 22% is fair value. And as of today, it was around something like 2021. So perhaps you are kind of reaching a point where you're at least at kind of a fair price.
If, again, I think there's definitely some element of the boardroom issues affecting the price in the short term. But at the same time, as you say, tech has done a bit better again recently. And that is the bread and butter for Scottish Mortgage. So I'm sure it's one that everyone will be keeping a close eye on in the weeks and months ahead. We are going to talk stock screens now. We are joined by our former colleague, Algie Hall, whose new book, 4 Ways to Beat the Market, comes out next month. Algie, welcome back to the show. How are you?
I'm very well. I'm all the better for being here.
Indeed, it's lovely to have you here in the studio. We did think you were going to be over the line, but you're here in a surprise appearance, so that's fantastic. The book itself, I should start by saying I found it a really insightful read, actually. It's very good at boiling down and explaining how to analyze balance sheets and read company accounts. I mean, we all know reading those accounts can be a difficult job, but in some ways explaining that to someone else can be equally tough, and I think it does a fantastic job at doing that.
Oh, thank you.
But the core of the book itself is about stock screens, sort of moving on from the accounting process to sort of see what you can do with that information. So can you sort of say a bit about what you wanted to do when in writing this book, what you hoped to have achieved?
Yeah, no, sure. I mean, I suppose part of the answer is in, what I ended up doing is in what you said. There's so many bits and pieces you have to explain in order to really understand what you're doing with stock screens as an individual. So really what I wanted to do was highlight some of the screens which have been very successful in the Investors Chronicle column. But really I want to highlight how readers can actually build their own screens and understand what they're doing. So in a way, you have to go back to first principles. You have to understand the accounts, because obviously that's the raw material from which you build screens, or create the ratios which kind of power a lot of the screening. But more importantly than that, you have to actually understand why the screen is going to work, what you're trying to achieve. And really, it comes down to understanding the kind of edge you're developing and the strategy you're following. So when it came to kind of thinking about these screens and thinking about why they worked, fundamental to it was to try and get a very good understanding of why certain strategies work. And often I think mainly it's behavioral reasons, which single out different strategies as being a good way to build an edge and beat the market.
The part of the book which is at the core, it is the four kind of types of screen that are used in the IC regularly still to this day. Maybe we just go through those, because another point about screens is they really tell you, they screen for ideas, of course, that's, the clue is in the name, but it's really what they can also then tell you about companies themselves and what they can imply or hint at about the underlying workings of different companies. And one way you use that in the book is with each of these four screens is you kind of show an example of times when the screen threw up something that actually turned out to be a great pick over the years to come, and times when sometimes it threw up something which nonetheless had some problems that were still, rather more embedded in the company, so it didn't end up being such a great performer. So, for example, the contrarian value screen you talk about on the plus side, Hill and Smith, on the downside, Ted Baker. Could you maybe just talk a little bit about either of those examples and how the screen kind of indicated what was to come for those businesses?
Well, yeah, no, absolutely. I mean, I with writing the book, one thing I really wanted to point out was the failures. Because often there's a lot of time devoted to, success in investing. But actually, if you can avoid the failures, and especially if they're failures which you can see in advance with a bit of work, then that's so valuable to investors. I mean, if you lose so much capital, you don't have enough to invest and make it back. That's, absolutely deadly. And a lot of the things that Ted Baker, taking the example that you've just given, they were fairly obvious if you use certain accounting ratios, balance sheet ratios, which I've highlighted in the book as red flag ratios. And with that company, there had been a whole lot of things going on which made it contrarian. But the issue in the accounts was that the level of stock at the company was rising as a proportion of sales precipitously. And what happened after the screen highlighted it, and it was a stock that I wrote up, and hopefully readers would have clocked on that. I was saying that there's, talking about the stock building in the column, but what happened afterwards all revolved around the stock. There had been a big overstatement of the value of stock, and stock is, essentially it's cost that's been incurred by a company, but they haven't yet pushed it through the profit and loss account. So if you have a lot of it, then all of a sudden, you've looked very profitable in the past, but there's suddenly this big, reckoning, and you realise the company was never as profitable as stated because a lot of it was just cost still, remaining on the balance sheet when it shouldn't have. And the business fundamentally, wasn't as good as everyone thought, and so in the future won't generate the kind of returns that people thought it was capable of. So with a contrarian play in particular, where you're looking for a company which has a kind of bounce back ability, as it were, that's, a really important thing to look out for, that, actually what was happening in the past could happen again in the future, rather than it having been really, not a genuine performance historically.
And quality is another screen that you look at, although, as you mentioned in the book as well, in some ways, ultimately, what you want, obviously, from any investment is a good quality company. Can you say a bit about some of the thinking behind that screen, and then maybe we bring in Alex as well, the current owner, if you will, of the screens, to talk a little bit about quality investing as well.
It's common ownership. It's common.
The keeper of the screen.
Yeah, the keeper, I should say. Yeah.
I passed him the seal when I left.
Yeah.
Yeah. No, I mean, quality is. I mean, if you want to ask the question, what makes a great company? There's really quite a simple answer, which is a company which can make a return on its investments, which is way more than the costs of those investments, and can also has the opportunity to invest at that level of return going forward into the future. And so quality is really about, quality investing is really about asking what makes a great company. And for the screen can look for the simple answer, because there are simple metrics you can use to test whether a company has the hallmarks of a quality company, because they are financial. As you were saying, it is the company we all want. We all want to find what we actually all want. We want to find the company which is a quality company, but people aren't recognizing it at the moment. So and sometimes that happens. There's also this opportunity just to buy quality. And there has been an issue with valuations getting inflated in that part of the market. I mean, less so now because we've had a kind of, a bit of a derating of quality plays. In general, the way I explain the success of quality in the book fundamentally comes down to the fact that we tend to think in straight lines. We kind of think of growth as a straight line affair. So, you're getting that much extra this year and the same amount extra next year. Whereas, as we kind of all have been educated to know, but we find it very hard to kind of actually, growth is actually a kind of upward sloping curve when it happens through compounding. And that's what makes people fantastically, wealthy. And it's the story essentially behind all the great, growth stories we have, like Costco or Amazon, all those type of companies. They grow at the same, a similar rate or an increasing rate every year, making an amazing return on those investments that they plow back into their companies, and they create ridiculous amounts of value for their shareholders. And also, one other thing that hopefully I make clear in that part of the book is that quality investing is very different or quality growth investing is very different to just growth investing, because growth can destroy value if you're paying over the odds, or your investment costs more than the return you're going to make on your investment. So I think that's also a trap that lots of people fall into, lots of private investors can fall into. They see a company growing very fast without asking what's the cost that they're paying for that growth. And if the cost is ahead of the return, then value is being destroyed.
Alex, what's your take on a quality company? Because again, this is a screen that's like some of the screens, they have moved with the times a little bit over the years as well. Some tests have been altered somewhat, which you need to do, I think, because market definitions change. But Alex, how do you sort of see the quality side of things?
Yeah, I mean, for me, quality, I suppose, if there's a pecking order to the different factors that you pick out in the book, and I suppose across the screens, I mean, value is the one that you can have the, arguably the biggest debate over. Quality kind of shows itself, but still, I suppose, having taken over the screens in what's been a really difficult period, it's been hard to untangle from, I suppose, the fundamentals of the quality businesses. Has something gone wrong with the businesses over the last year or so, or was it all down to their kind of like juicy evaluation? So that's been something that I've struggled to sort of pick apart a little bit over the last year. I mean, every stock is a different case, and you can boil it down to the individual stock. But I suppose as a sort of theme, quality is one which has been interesting to write about over the last year, but hard. I mean, one I did want to ask you about was momentum, which you sort of look at in the Great Expectations screen. I mean, one feature of the screens we've not talked about is that they're kind of structured as annually revised phenomenon, which is is kind of like an arbitrary rule almost. You could run the screens indefinitely, and do very well, and you pick out some of the companies which, had you just stayed with them, had you just stayed with Games Workshop after 2017, it would have been happy days sort of thing. But momentum I find really interesting because it seems so powerful in the way it works over certain periods, but identifying what is the strongest use of a period is the real hard question here. Is it a year? Is it a quarter? What's kind of your take on having surveyed this for a decade plus?
Well, it's a very good question, and so good I don't have an answer really for people listening. the reason why the screens are annually is because we're journalists and we rotate them. We want them to fresh ideas for our readers. And obviously, if you find a great company, you try and hold on to it. But I think with momentum, there's one massive danger with it, which is the whipsaws. Because if you get a big change in sentiment, you've got a stock which is really firmly attached to that sentiment. So the end of the post-pandemic boom, end of 2021, that's a classic example for me. Which I highlight in the book, where stocks just blew up, which which were totally built up around the idea that everything would continue to be as it was in terms of their trading, and also they were massively overvalued and overhyped. So I mean, with a stock like that, you just have to be careful about going close to it. I mean, if you play with fire, you're going to get burnt, kind of thing. But I think momentum's kind of agnostic in terms of style, and I'd say probably people who are trying to use it to identify interesting situations need to be a bit agnostic in terms of thinking about the time frame, the situation it's leading them into, because if you've kind of got a company which is maybe going through a recovery, becoming something different, becoming very hot because of that, actually those kind of stories can have ages to run. I think one of the stocks which is highlighted in the book is JD Sports, which a different screen actually caught at a very similar phase in its development, the dividend screen. And it was really not looking very special, but it was being turned around, and the virtues of its business model was starting to come to the fore. And I think that was captured also by the momentum screen later on. And that's just it's a really good business case. And the reason why it's exceptionally hot in, over a certain time period is because it's just becoming apparent. And those kind of stories don't necessarily die down, when they're associated with those long-term compounding of returns. But then something else, more cyclical, you're looking for the end of the cycle, and you're looking for a build-up in, supply, competition coming on, all those, the classic signs that you're late in a cycle and the returns are going to wane. And then, if it's just speculative, I kind of, think often with those stocks, why go there? Is investors don't need to.
You mentioned dividend investing there, and that is kind of the fourth section, as well as momentum, contrarian value, quality, the dividend investing, which you distinguish from income investing in that quite often, from a private investor's point of view, it's the high yield, low risk screen. And it's quite interesting because these are the kind of stocks that for professional fund managers, it can be difficult to hold because they're dull but reliable, I think you call them, which means, they can underperform in a bull market. So there's a career risk element there. But nonetheless, these are the kind of stocks that over time can compound really well. And also the point you make is that these kind of stocks, that they pay dividends, the way that you kind of consider dividends as a benefit is not so much the payout itself, but what that says about the company and what that says about the reliability of the company.
I think dividends in the UK, we have a very odd relationship with dividends, which I think is around the marketing of income funds and things like that. It's very hard to understand if you actually pull it apart and think about it logically. So I think it's really important for investors to realise that receiving dividends is a zero-sum game. It's when your stock goes ex-dividend, it falls by the amount of the dividend that's been paid out. And for management, it's simply a capital allocation decision. It's the management's job is as capital allocators, and they have a certain amount of cash at the end of the year, and they say, okay, some of it, we need to spend on maintenance and whatever. Then we think about investing in growing this business. So if they're good investment opportunities, returns expected to be over the cost of capital, then let's go for it. But everything else is well, we better just give it back. We don't, they could pay down debt, obviously, make acquisitions, etc. But essentially, the dividend is, just the leftover bit, and it's really, it's a capital allocation of the last resort in a way. It's kind of, back to you, shareholder, do what you will with it. So it's not the sign of, good things. It's actually the sign that, this is a slightly mature business with a limited opportunity set. However, what's really interesting is that it tells us something about the capital allocation of your average management team. The fact that this type of stock is, all the strategies, I should say, there's a really rich academic history and testing by the finance industry, which shows that it's not just the screen performances, which I talk about over 10 years. As these are things which actually do have solid foundations. But so the fact that stocks which have less volatile shares is the other important ingredient, and pay out steady dividends, the fact they underperform tells us that the average management team probably tends to allocate capital badly. And they spend money wastefully on projects which don't produce the kind of returns that investors should expect. So when you have these conservative management teams, and it's often associated with families with high companies with high levels of family ownership, which are credited with having more multi-generational thinking, they outperform due to conservatism because they're just they're keeping a strong balance sheet, not doing anything too jazzy, just looking at what matters to make sure things tide over, and the money keeps rolling in. They're really interesting from that regard, but the income is just the income psychologically, probably for some investors it's really helpful just to have that dividend check land in the bank, rather than having to make the decision to, okay, I want this much income, so I'm going to sell this much of my holding of whatever. But if you look at it rationally, there's no difference. It's like you don't need someone paying you dividends to create an income stream, and it's actually far more efficient to have it just ploughed back in by the company itself.
We're running out of time, unfortunately, but Alex, I know there's another thing you wanted to pick up, which is just on the idea of factors behind all these screens, essentially, be they quality, dividend, what have you, about them being arbitraged away over time. Some research to this end.
Yeah.
Well,
It's it's often it completely depends on how you measure it, and I think that this research that I was showing you the other day that I saw from Man Group, there was an analyst suggesting that the factor premiums that you might have seen a generation ago or 15 years ago showing a bit of decay, i.e. that if there's any edge to be had through factors, we've got so many investors jumping on those edges that they disappear or arbitraged away. Is that?
I'd say logically, wouldn't you think that has to make sense? Probably.
Mm.
I think I kind of think that in terms of factors, they're interesting because they tell us something kind of happens in terms of why they're interesting to me, at least, is they tell they say certain things are kind of like missed by the market, and this is it's kind of like there's something deeply ingrained in us as investors, which means we overlook certain situations. And so I think that's the way they really point to, there's an edge here probably. Or, we can, we should think there's an edge here. And I suppose in terms of taking those factors and converting them into stock screens, the screens which, I did and you do are kind of far more specific. They're not kind of just saying, give me all the, low vol stocks. They're saying, I want low vol, I want a dividend track record, I want a yield which looks interesting. And you get a far more bespoke, if you like, smaller selection of stocks, which then are, there'll be some really, normally, touch wood. There's, there are some good ideas in there. And there's, I think, the thing for the private investor, any investor, is to, roll up their sleeves and then really understand where the good ideas are. But, in doing that, the value of having a screen and having a really clear strategy behind what you're doing is that you can really focus in on something that works and you can stay consistent, which is a really important thing for kind of building what people call a behavioral advantage, because it kind of means you're acting in a way which is more rational than other investors and more consistent. And that's really what I think is the biggest win for most private investors. That's what private investors can go for, because the other type of advantages which allow for outperformance, they are really the preserve of big, well-financed institutions. But the behavioural advantage is probably actually the biggest advantage you can have by, using your common sense, but just having something, a process which will allow you to stick to your guns and not be panicked to do something stupid or be seduced by something which that takes you outside your comfort zone.
Yeah, that and a 5 megabyte spreadsheet that crashes every time I try to open it.
I think I've probably left you with some spreadsheets which are a bit bigger than they needed to be.
The Excel data behind these sheets here is quite weighty.
Hey, computer power will only grow.
Indeed. On that note, unfortunately, we have come to the end of the show, but Algie, thank you so much for joining us. Thank you to everyone today, to Alex, to Julian, and to Dave. We'll see you next time on another Companies and Markets show.